Right, so on to the cash budget for July to October 16. So July, August, September, October, you don't need to do the November. You won't be using that like you needed it in the production and the raw materials purchases budget. So as normal, we'll start with receipts. What information are we given about receipts? As normal in a cash budget question, there's a split of the sales revenue between cash and credit. So it says cash customers, 30% of sales revenue will be for immediate cash. So the July 270 grand, we're going to get 30% of that straight away. So 270,000 multiplied by 30% is 81,000. So cash sales in July, 81,000. 70% of sales revenue will be from credit customers. These debtors will pay their bills 50% in the month after and the remainder in the second month after sale. So we're going to have credit sales 1 month and credit sales 2 months. So of the 270 grand in July, 70% of that is credit, a half in August and a half in September. So 94,500, 94,500. August then 292,500. So 30% straight away is 87,750. 70% of it then is 204,750. So half of that is 102,375. September then is 330,000. So 30% of that is 99,000. 70% of that then is 231. We get half of that 1 month after sale, so that's divided by 2. I'll go again. So 330 grand by 70% by 50% is 115,500. And then that'll be received then 2 months later in November, but we're not doing the budget for November. October's sales revenue then is 360, so 30% of that is 108,000. Okay, the business has started up in July, so there's no 1 month sales in July because there was no June sales. There's no 2 month sales in July. There's no 2 month sales in August either. So I'll just total up the receipts then. So that's 81,000. Here it's 182,250. Here it's 295,875. And here it's 325,875. And then I didn't do a total column here. You could do it if you want. There's no marks going for it, so it will just be to kind of check your totals as a way of doing a cross check and making sure you've got the closing balance right. I'll leave it up to you whether or not to do it. Your payments then. So we've got purchases. And what's to tell you about purchases? 1 month's credit is received from suppliers. So the purchases figure is your raw materials purchases from the production budget, or from the raw material purchases budget that you've done. Okay, so these are your purchases figures, and we get 1 month credit. Okay, so we buy 203,400 worth in July, and we pay for that in August. All right, so payments, credit, purchases. So the 203,400 is coming in August. August then are coming in September, 128,640. And September's in October, 140,880. Okay, there is no June purchases to be paid for in July, so that'll just be blank. All right. So that's it for purchases. They don't split them between cash and credit. You'll notice with the sales as well, there was no discount to be worrying about when paying with cash, because you need to do these extra couple of bits at the start. They'll kind of take a couple of bits off what we normally have to do in a cash budget. So other payments then. So have we dealt with everything? We've done with this. We've dealt 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 with this. So we're down at the expected cost. So wages 10% plus 5% of sales revenue per month payable as incurred. So 5% of sales revenue per month. Okay. So not the sales receipts, the sales revenue. Okay, so in July that'll be 10,000 plus 5% of 270, so 270,000 multiplied by 5% is 13,500, plus the 10,000 here is 23,500 for wages, and payable as incurred, so that's paid in July, so 23,500. In August then, so 292,500 sales by 5% is 14,625, plus 10 grand, 24,625, and so on. Okay, so September 330 by 5% plus 10 grand is going to be 26,500, and October 5% of this plus 10,000 is 28,000. Again, variable overheads €4 per unit payable as incurred. So often these questions we will get sales revenue and selling price per unit, and we'll work out sales units, and that's what we'll multiply by variable overheads. We'll kind of use sales units as a stand-in for production. But in this question, we actually know how many units are produced each month. So that's what I'm going to multiply the variable overheads by in this question. So €4 per unit. So for July, it's going to be 14,850 by €4. So variable overheads. So €4 multiplied by 14,850 is 59,400. August then, 10,500 by 4 is 42,000. September 11,600 by 4 is 46,400, and October the 12,300 by 4 is 49,200. Next up, we've got fixed overheads, including depreciation, are 28,000 a month. Okay, so a pretty normal kind of adjustment there we have to make to these. The 28,000 includes depreciation. That's not a movement of cash, so we need to strip that out. So the depreciation, then we get that information in the capital costs. So equipment will be purchased on the 1st of July. Let's just maybe put workings down here. So equipment costs 60,000. Useful life of 5 years. That gives you 12,000 euro a year depreciation, divided by 12 months is 1,000 euro depreciation per month. So we're going to take that 1,000 out of the 28,000. So fixed overheads, 28 minus 1 is 27,000 per month. Now, what other movements are here? So equipment will be purchased on 1 July for 60 grand. So that's a flow of cash in July. 60 grand out. To finance this purchase, a loan of 48,000 will be secured. So that loan will be received in July to pay for the 60 grand equipment, but we don't deal with that until the opening cash, net cash section down the bottom is where we put that 48 grand in. But what's it tell us about the loan? So it will be secured at 10% per annum. The loan and interest will be repaid over 4 years. monthly capital and interest payments will commence in August. So we need to put in capital repayments and interest repayments from August. So how much will they be? So the capital ones. So it's a 48,000 loan. And we're told it's going to be repaid over 4 years. So that's 12,000 per year. So each month, that's 1,000. So loan repayment per month. And then the interest is 10%. So 48,000 by 10% is 4,800 interest per year, divided by 12 months in a year is €400 interest per month. Okay, it doesn't mention that the interest is calculated based on the balance of the loan at the start of the month or anything like that, so we don't need to recalculate the interest every month, kind of falling down month by month. It's just going to be the 400 per month. So loan repayments and interest, just it says they'll commence in August, so don't start those until August. So loan repayments 1,000, 1,000, 1,000. Interest then 400, 400, 400. So add together all your payments then. So that's 169,900 here in July. In August, they will be 298,425, 229,940. and 246,480. So that gives me net cash. So receipts take away payments. So that will be negative in July. It'll be 88,900. In August, negative again. So 116,175. September, positive for the first time, so subtract those and you get 65,935. And in October, 325, take away the 246 is 79,395. So what then are we going to have? We're going to have a loan coming in. We're going to have opening cash. And we're going to have closing cash. So the loan is coming in July, and it's 48,000. Okay, so it tells me how much the loan is for. If it didn't mention a figure, I'd assume it's for the full 60, but it tells me it's a loan of 48 grand. Opening cash balance. It's a startup business and they don't mention the owners putting in capital from the start, so opening cash is going to be 0. So net cash plus the loan plus the opening cash gives me closing cash balance of 40,900 negative. Okay, that's obviously your opening cash then in August, so bring that up. Minus 116 and minus 40 is minus 157.75. Bring it up. Add those together, you get minus 91,140. Bring that up. Add those together, minus 11,745. So if we'd done total columns here, we'd be able to do a total column and check that the closing cash matches. I haven't done one here, so I don't have that inbuilt check. All right, I will finish off then and do the trading profit and loss account, budgeted trading profit and loss account in a separate video.